Welcome back to our YouTube channel, and today we want to continue with our tutorials. And today basically we want to look at the performance of the firm, the financial performance of the firm, because I told you we are going to start by first analyzing the ratios, then we go to corporate restructuring, we go to Islamic finance, we first handle the easy marks, and then we proceed to the following topics as we highlighted in our overview of the course of the paper in the previous lecture. But before we look at the financial performance of a firm, I want us to finalize with the introductory part. We first look at what do we need for this paper, or what are the things should we equip ourselves with when we are going for this paper. So let's try to look at the tools to be used in the paper. In other words, in this whole tutorials, what do you need to have as the basic things that you should be having for you to be able to excel or to pass this paper with good marks? So I expect that every student at least should have latest past papers, and the past papers you should have, they should be ranging from, I think, November 2018 to date. Just have the listen, because given the fact that the syllabus was revised. And the other thing that you need to note is that you are supposed to have the listen past papers. These are going to be past papers, but you also make sure you also get and their marking guides or solutions, at least from November or May 2018 to date. So if you get those past papers with their respective solutions or marking guides, I know some marking guides have some errors, but we shall be able to highlight some of these aspects as we go on, but have those with you. And that's one. Then the other thing that you need to note on these past papers is the fact that we have a new examiner. The previous past papers we had a different examiner. So the old examiner started those papers that from November 2018 to I think August 2019. These were for previous examiner. So the new examiner is starting from November 2019 to date. So we want to utilize this. The reason that's why we are picking some more, at least we are picking some more past papers from the previous examiner to see how this person was actually setting these aspects. But if you try to compare and contrast, you'll be seeing some small difference in how the old examiner used to examine the paper and based on how the new examiner is doing it. So this November 2018 to 2019 to date will give you some challenge. It will make you understand, because previously things were a little bit direct, but they were not all that direct, but they were somehow direct. But here the things are not all that straightforward, but they are easy to understand as long as you understand the concept. So the older past papers below November 2018 were not all that hard. So even if you try to compare, if let's say you compare numbers of 2018, let's say June 2018, and you compare them with the numbers of, let's say, September 2022, you will see that they are totally different questions. I know that given the fact that the syllabus was about to change, but there are some slight differences as we shall be able to look at. So we want now to focus on the financial performance of a firm, financial performance of an organization. So financial performance, it's a topic that it remains a little bit silent in this new syllabus. It's there, but it's hidden. It remains a little bit silent in this new syllabus. And this new syllabus, it talks about it very briefly, where under the financial markets, if you look at that detailed syllabus, financial markets, that's where it was brought. And it is a little bit silent. And the way they brought it, it's as if you're just going to be using what we call the use of market ratio, use of market ratios. So when you try to look at that detailed analysis, under the financial markets, you'll be seeing use of market ratios in financial decisions. So it is a concern that we can see, but it is a bit hidden. In other words, the examiner is only talking about the market, these market ratios, because we know that is only talking about the market ratios and is ignoring other ratios. Is talking about market ratios in a sense that these other ratios, we did them on our level 2 financial management, but on the advanced, because the market ratios on level 2, we don't look at it in detail. We always focus on the detailed analysis of these other ratios, but we give out the we talk less on the market ratios, and that's why the examiner is bringing them here, only market ratios. But that doesn't mean that he can't examine other ratios, and that's why we can't trust the examiner to say that we are not going to revise the market ratios, because we have some numbers that happened, especially in the previous syllabus. So they are talking about market ratios because the examiner expects us to be knowing the other ratios, because those other ratios, we talked about them in our financial management. That is a paper on level 2. But that doesn't conclude that the examiner can't bring a number on ratios. In the old syllabus, we saw the examiner examined the ratios September 2022, question 2. That's when we started to see those numbers coming up. And this number, actually, majority of the students didn't do it because it came as a surprise to them because they never expected it to appear. They thought it is a paper it's a number that is supposed to appear in the financial management paper on level 2. So when we are doing these ratios, we make sure that we analyze the performance of the firm. We look at all the ratios. So I'm going to try to teach it in my own perspective, but just nothing much I'm going to communicate, because these are some of the things that you already know. We are just going to have a recap on what should be done. But what you have to understand is that we want to start with financial performance of the firm, and I'm going to teach it in my own perspective. And after this, then we shall look at corporate governance. So I want you to kindly note that, because it's something that is going to be of more important. So let's look at, we know that those financial ratios, the ratios, they are within the topic of financial analysis. So when you are told to do financial performance of the firm, to evaluate the financial performance, you're supposed to use ratios. So when you want to analyze the performance of any company, we shall use, it is always, we use ratios. Even though there are other methods that we can use to analyze, there are other methods. The other methods that we have that analyze the financial performance, we have the short analysis. These ones can also analyze. We have the pastel. we have the Boston Consulting Group, BCG. We have Porter's 5 forces. These are things that you will have in your business strategy paper, that paper about leadership. That's where some of these things will be in. So we don't use, even if you can analyze the business using these tools, we always analyze ratios. The reason why we are analyzing using ratios is because here we are basically looking at the financial aspect. So we use ratios to analyze. But now, when you are dealing with ratios, ratios are divided into 5 categories. 5 categories of ratios. We have 5 categories of ratios where we can analyze the profitability of the company, where you can analyze the liquidity, where you can also analyze the gearing of the company. The fourth one is the investor ratio, or what we call the investment ratios. And these investor ratios, or the investment ratios, these are the ones the examiner is calling the market ratios. And this is where the syllabus is focusing on these ones, the market ratio. But the last one, or the last category that we have, is what we call the efficiency ratios. And this looks at how efficient are we managing our working capital. So this one is basically more on working capital management. And we know that on level 3, of course, we don't go so much into the aspects of working capital management. Those are done on level 2, financial management. But here, the working capital, we don't talk about much about it. But that doesn't explain the fact that the examiner can't ask them, because he knows you studied these things on level 2. That's why these papers are interlinking. They also have exemptions that you can't do financial management and at the same time you do advanced financial management at the same time. It is impossible. They don't allow it. Just like the same way you can't do taxation on level 2 and at the same time you are doing advanced taxation, because most of the times the papers may be set at the same, they may be done on the same day. These people on level 1, on level 2, they are doing taxation, and also at that same time, the ones on level 3, they are doing advanced taxation. So you can't be here and at the same time you be the other side. Just like the way you can't do financial accounting at the same time you are doing financial reporting, or doing financial reporting and at the same time you are doing advanced financial reporting. So those are some of the things that you have to be careful with. Even though it's not all that in the syllabus is only talking about these market ratios. And the reason why they are not talking about these other ratios is because we looked at all these profitability ratios, we looked at liquidity ratios, we looked at gearing, we looked at efficiency ratios on level 2. Even these ones, we mentioned them, the market ratios, but we didn't go much into details. So here, the syllabus wants us to have a detailed analysis on those marketing ratios. So that's basically what the examiner will be targeting. And most of the times here, they may not tell you to compute, they may not specify that you compute such and such ratios. They may just tell you, evaluate the performance of the business, write a report based on the information given above, trying to evaluate the performance of that business in the question. And it will be upon you to to look for the ratios that are falling into these 5 categories that we have. Maybe you give like 3 here, 2 here, 2 here. Let's say even here you give 2, even here you compute like 3, and you make a decision. You don't just compute. You have to defend your answers. You remember, we said for ratios you must explain your results. So, what do we need to do when we are handling any number on ratios? So, we want to look at when we are analyzing resources, when we are analyzing ratios, what do we focus on? We don't simply compute ratios. When we are analyzing ratios, we compute, and at the same time we do what we call either a trend analysis, or we can look at the performance, how maybe the performance is based on the industrial average, based on whichever information that they have provided for us. So we don't simply compute ratios. You compute, then we also do what we call trend analysis. So we compute the ratios, then you go ahead and do a trend analysis, and by trend analysis, because of course you compute, let me just be methodical. You compute the ratio, then you also come and do trend analysis, basically. And when someone talks about trend analysis, you look at the performance of the company. You compare the performance of the company, maybe for a given year, maybe for this year one, let's say this is 2020 to 2023 or 2021. Then this one is 2019. So you keep comparing the performance of 2019 with that of the preceding year. If this one we had 20 million and this one we have 25, it means there has been an increase of 5 million. That's what we call a trend analysis. There has been some improvement. If this has been maybe 15, but this one is 10, then it means there was a decrease in the performance of the company. So when someone talks about a trend, you look at the performance of the company, maybe this year, in line with the different years. If this one, maybe this one came to 22, maybe this one went back maybe to 30 million. So you'll be seeing that this one, they performed better, they reduced, but again, they rose up. But here they performed, increased, but here they went down. So that's what we are trying to look at. What is the general picture of the performance of the business? Has it increased or has it reduced? So we look at either there is a growth or there is a decline. So basically, when you're trying to look at trend analysis, you are looking at a growth or a decline. And this is how you will be explaining. You based on either the decline or the growth to make sure that you make a conclusion. So that's one aspect. That's one way of how we can analyze ratios. The other way, the second approach that you can do analysis of the performance of the business or analyzing ratios is we can look at the performance. We can look at the performance of other companies other companies in the similar industry, in the same industry, and then we make a comparison, and then we make our comparison. So for example, we look at the businesses that are within the same sector. Let's say maybe we are trying to analyze the performance of, let's say, communication sector, media houses. Maybe we have, let's say we are in communication industry, and we pick out two companies. We can look at MTN Group, and then Airtel company or group. So we try to look at the industrial averages. We look at the industrial average. If you are the accountant in MTN, you try to look at what is the industrial average of the whole sector for communication. You compare that with how you are performing to see your performance vis-a-vis the industry. If it is a manufacturing company, you look at maybe Kakira Sugar, you also compare it to maybe with Rugazi to see how that sugar manufacturing is moving. So we may have these industrial averages as our benchmarks. We have those as benchmarks for us to be able to analyze our performance. So just like the way I've said, you can look at MTN Uganda, you can compare yourself with the industrial or the sector average. The sector averages will be, of course, given to you if at all they want you to look at the performance based on the industrial averages. And most of the times these companies, they compare. If at all you have to make a comparison between two companies, they must be at the same, at least almost the same level, but they must be in the same industry. You can't compare a manufacturing company with the communication media house. It will not make sense because they will be having different risks. But the reason that's why we are looking at the industry is because we expect that all companies that are within that sector, they are facing the same business risks and other kind of risks. So the third way that we can analyze ratios, the third way could be, we may find ourselves that we are not comparing. You don't compare industrial average. You don't compare industrial or what we call the sector averages. You don't compare the industrial or sector averages. And you'll find yourself, maybe you could look at a company in the same industry, a company in a similar industry. It's different from the one where you are using the industrial average, because here you will be going by MTN, Airtel, and MTN. You compare the performance of Airtel vis-a-vis the performance of MTN. But with industrial averages, you just compare. You have one company, let's say Airtel, then here you have the industrial averages that you are comparing against. So you are comparing your performance with the industrial averages. But here we compare company with company, and these companies are supposed to be in the same industry. And these companies, the other thing is the fact that they are supposed to be of relatively equal size. If I'm comparing Rugazi Sugar Company and I'm comparing it with Kakira, but you can't compare a startup company with a company that has been there in existence for so many years. especially when this company has just started and it hasn't accumulated anything. Now, at the end of the day, these are the three ways that we can analyze ratios. But at the end of the day, the examiner wants us to write a report. As I said, we basically look at a report. At the end of the day, the examiner will require us to write a report explaining maybe the performance of the business. So you will start with the report, you will write the report based on the computations. Of course, you will bring the computation after writing the report. Now, someone is going to be wondering, what should I be doing, or what should I put in the report? Of course, in the report, you will put the computations, you will just bring in the results. You will put the computations as your workings, as attachments. Of course, we know that attachments, they are going to be in the appendices. We explained how we'll be able to do a report and a memo in our videos. So, but what you should know is the fact that if you are going to be writing a report and you are going to be dealing with ratios, the first step is to do the workings. And these workings, because you need workings that you are going to reference your results to, the report will be a brief aspect. But when you're analyzing your workings, these workings are going to be in three ways. You follow these modules or these three steps. Number one, you state the ratio and its formula. Number two, you compute the ratio. Number three, you interpret or you comment on the results. You don't just compute. So whenever you are talking about ratios, you are supposed to do them in this, using these three steps. So some students, they just compute and they don't comment. So if you end on computing, you will be not, it doesn't mean that you are going to be marked wrong if you stop here, but you will not get this one extra mark for commenting. Even if they don't tell you that you comment, for ratios we comment. Commenting carries at least 1 mark. And we've said that when you are commenting, you are just trying to do a trend analysis, just explaining whether there has been a growth or a decline. And that's all that you need to understand from the financial analysis or ratio analysis. And that's the recap I wanted us to get. I'm not going to go into giving the formulas. We shall just do numbers because I expect that you'll be knowing the formulas. But get the other aspect that here, the examiner will not specify which ratios to compute. Most of the times, the examiner just tells you, assess the performance of the business or assess the financial performance of the business based on the information given above. So you'll find yourself you have to group these ratios into those 5 categories and then you make computations. So that's basically what I wanted you to understand. The rest is just all about doing numbers. The same way we've been doing numbers is the same way that we are going to do them here. But that's some small analysis I wanted you to have. So the other topic that we are going to look at is going to be the Islamic finance, but this is going to be in the next video. Islamic finance. It's a new area on level 2. but here we've been having this Islamic finance even in the old syllabus. So Islamic finance, we are going to focus on how we can be able to get the easy marks, because we said with Islamic finance, that's one way of how we can be able to get the easy marks. Now, Islamic finance, as we said in the previous video, that the easy marks are here, and it's what we are going to put in context today, so that you can be able to understand what is involved within the Islamic finance, based on the fact that this is an advancement of what we covered on level 2. So most tutors or most lecturers, they teach Islamic finance as one of the last topics, or towards the end of the syllabus, among those last topics. But my approach is to bring these theoretical aspects that have a higher potential of appearing in question 1 first, so that we first get those easy marks. So my approach is to bring these ideas, these aspects, things of international concern first in this early period, so that we understand the theory before we go into the computations, because I also know that the computations are going to, by the time we reach on computations, we are going to find ourselves busy. So if we get this first, it will be one way of saving time as far as managing passing is concerned. So this is a new area, especially in Uganda, and it's a new area that we need to clearly first understand before we get busy into these computations. And as I said, it is an international concern, so we have to put it in context early. I hope to finish this Islamic finance, then I go back to corporate governance, because we said that corporate governance and Islamic finance, those are the two topics that have a higher potential of appearing in question 1, section A, question 1. So I want us to first understand those two, then before we get into the computation, so that we can first maximize those easy marks. And that's why that's the approach I'm using as to why I'm starting with them. So we want to understand the theory behind this Islamic finance. But one thing that you need to appreciate is the fact that in this paper 15, Islamic finance is examined in question 1, and it is always there. If I told you look at the past paper numbers, it's always there. It is always there because it is an international concern. Remember, we saw the examiner's expectations. They expect us to be knowing things, that the modern developments that are coming in the area, that are coming in the area of finance, and this is one of the things. So it's an international concern, and we need to capture these easy marks. And you can find a question, it can take up to 10 marks. You can find that question and it is taking up to 10 marks. Just like the way, if you look at question 1, part C, June 2022, where the examiner tells us to discuss the benefits that a company would derive in using Islamic finance. So such questions, it was asking the benefits that a company would derive in using Islamic finance and the likely drawbacks it would face, and they gave it 8 marks. So if you see Islamic finance is carrying 8 marks, so it means it's an area that you need to look at in detail. So here, specifically in this question, it just wanted us to look at the advantages and the disadvantages of Islamic finance, which are not hard to answer, and anyone can actually be able to score those 3 marks. We have some other questions that we can reference on. Questions we can look at, I've already talked about this question 1 June 2022. We have even March, also March 2022 it was there. Question 1 part G. This was 6 marks. We also have December 2021, question 1 part E. That was part E. It was also carrying 6 marks. If you look at also December 2020, question 1 part E, it had 8 marks. The other, you can also look at August 2018, question 1 part D. It also had 8 marks. If you look at November 2018, question 1 part B, Roman numeral 2, it also had 6 marks. Even if you look at May 2019, question 1 part E, it had 8 marks. August 2019, question 1 part E had 9 marks. Also November 2019, question 1 part C, this was 4 marks. And the highest when they brought it as a standalone question was in August 2016, question 3. It was carrying 25 marks. So such a number or such a topic is really something that we can predict and say that we should understand it. So we are sure, even if we just take it at the bare minimum of getting 6 marks, bare minimum of looking for 6 marks, that you are sure if I understand Islamic finance, I've got my 6 marks as a benchmark. You will be looking for only 44 minus doing any computation. So if it happens that we have also corporate governance in the same paper, then it will be something that you need to focus on and put some emphasis. So let's try to understand what Islamic finance is all about. That was just like to get ourselves started to what we are looking at. We look at the likelihood of this to happen. One thing that you need to note is the fact that not all Muslims actually understand Islamic finance. Don't say that these are things for Muslims. No. These products, they are a bit new, especially in our country. I've seen Salam Bank, I think. At least I've seen so many branches of it. They are coming up. So let's now try maybe to look at the introductory part. So introduction to Islamic finance. We first shed some background of how it came into play. Introduction to Islamic finance. Now, Islamic finance rests or bases on the application. It bases on the application of Islamic or Sharia laws. Application of Islamic laws or Sharia laws. That's where it gets all its powers. And when we say Sharia laws or Islamic laws, basically Sharia laws, we have two things. We have, if we talk about the Sharia law, we have two things. One, we have the Holy Quran. I don't know whether that's the correct spelling. Quran. Then we also have the sayings of Prophet Muhammad. The sayings of Prophet Muhammad. And these sayings, they are the ones that are backing up. These sayings of Prophet Muhammad, they are the ones that are backing up the Sharia law. They are actually the ones that are backing up this Sharia law. So, all these sayings of Prophet Muhammad that are backing up the Sharia law were merged into what we call the Holy Quran. So they are the ones that are giving us the scope of things that are supposed to be included and those that are not supposed to be included. Then if we try to maybe to look at how it came into existence, how Islamic finance became operational. In other words, looking at the history of Islamic finance. So the issues Prophet Muhammad used to talk about in those years, they are the ones that started this process. They are the ones that are going to guide us on what is supposed to be included. Of course, those sayings came about as, you know, from the time Islam came into existence, or the process of Islamic faith started. So, the other point that you need to take, or that you need to understand, is the history, how it came into existence, but not necessarily how it came into existence, but what are the recent developments, because we can't be living in the past, but we are using the past to see what is happening. So we now need to look at the history of Islamic finance. We just want to look at the origin, how it started to operate. We've known that it came from the aspect of the Sharia law, that the law that was basing on the sayings of Prophet Muhammad that were organized into what we call the Holy Quran. So our interest is not to go deep into what the Quran is talking about, but we want to pick out the basic principles that are going to help us navigate through this aspect. So we need to know how it came about, the recent history that we have. Of course, based on the books, we have from 1970s. That's basically how we can document what we are doing. 70s. This is when we started to see Islamic banks internationally. Islamic banks, actually these were in Saudi Arabia, UAE, United Arab Emirates. That's when those banks were launched. And it's now, to date, of course, it's now estimated to be worldwide to be around $2 trillion in assets. $1 trillion of assets. In other words, it has developed over years, because we've tried to see very many countries have started having the both, of course, like here in Uganda we have both the commercial and also we have the Islamic point of view. But we shall see what differentiates Islamic banks from the conventional banks that we know. But all the aspects, all the formation of these Islamic banks is as a result of these banks following what we call the Islamic laws. So all these, we've seen that over 2 trillion US dollars of assets, they are following that pattern of Islamic finance. The rules, of course, they are rules of Islamic that are governing Islamic finance. So Islamic finance is now a global thing. And that's why, even being that CPA is also an international stuff, it is something that you can't avoid. So Islamic finance is becoming widely recognized. I've told you that even in Uganda we have some banks. Of course, in the past we had issues on how they can operate alongside with these other conventional banks, but at least we are seeing some, but the industry is just developing. So it's something that we need to understand. And of course, the examiner will not ask you anything on the definition that you define what an Islamic finance is. There is also no need for you to read the whole Quran to know what Prophet Muhammad was talking about in order for you to understand, to be able to get the concepts that are going to help you pass. No, some of these things we just pick out few things, especially the rules that are governing the applicability or the application of Islamic finance and its Sharia laws. So you don't need to read the whole Quran to be able to understand Islamic finance, but you need to have just a brief background. If you are given a question, you can just give a brief background about what it's all about. So the examiner will examine you on the principles. These are some of the things the examiner will ask you on. The examiner will ask you on the principles of Islamic finance, principles of Islamic finance, and therefore you need to understand what they are. They are more than 10, but for us we shall talk about like 6 or 5. We analyze them in detail, because these principles, they are the ones that are going to guide us on what is supposed to be done, what's not supposed to be done. Principles of Islamic finance. So we can maybe mention some of them, then we come into the next video and we give a detailed analysis of what these are. One of them, we have paying or charging interest. Because we know from the banking perspective, the business operations are supposed to be earning interest. From the banking perspective, we know that. So we want to know, how is Islamic banking or Islamic finance affecting or reacting on the issue of paying or charging interest? What are the principles? What are they saying about charging interest? Those are the things that we are going to analyze. 2, we have investing in business. Investing in business involved in prohibited activities. Businesses involved in prohibited activities. There are some prohibited activities that they don't want to say that we've got an Islamic finance or an Islamic bond and you are investing in such kind of business. There are those that are prohibited, as we shall look at them. But we need to understand, because but if you are giving finance, if it's a source of finance, then you are supposed to be funding operations of the business. But where you are supposed to put money, there are restrictions that you shouldn't put money in such and such activities. And those are the ones that we shall look at. So we want to look at what those activities that are going to be allowed as per the Sharia law. 3, we shall talk about speculation. Speculations. How is Islamic finance handling the issues or businesses to do with the speculation, like gambling, holding products so that you can overcharge customers, things to do with, let's say, betting companies, things to do with other businesses that derivatives, like those who are dealing in forex and other kind of business. We shall be seeing how we can be able to navigate through those. What are they saying, or what is the Sharia law talks about in regards to speculation? Then we shall also look at how you deal with uncertainties and risk. How does it deals with, because in banking we know risk and uncertainty, it is there. You give people money, you are sure some of them will not pay. How are they tackling that aspect? So how to deal with risks and uncertainties. The other, we shall also look at the fact that risks are supposed to be shared. Risks should be shared, and we shall be seeing shared among which people. They are also saying that wealth must be generated from legit trade and asset-based business. They are saying for them, you don't just give out cash, but the physical asset you should actually have a physical asset that you are giving the money against. If someone wants to borrow money, the person should tell you what he's going to do with the money that they are borrowing. So they are looking at legitimate business. In other words, you don't have things to do with man on money kind of transaction. They are not existing there. So these that we have highlighted, there are very many others, but as I said, we can't just read the whole Quran to understand what we just pick the few things that we need. So these that we have highlighted, they are just an outline, but we need to understand them one by one in detail and what they mean. Because if you understand these principles, they are the ones that are going to enable you on anything you are going to be doing. If you are explaining the types of Islamic finances, if you are explaining the benefits, you should be knowing the scope, that if I'm to apply finance, Islamic finance, if I'm borrowing money, if I'm getting money from an Islamic bank, I'm supposed to do that money for such and such activities. There are these activities that I'm not supposed to put the money that I've got from that idea. Then we shall also look at the advisory. How are they advised? Who supervises the activities? Because you can't Like for commercial banks, we know that commercial banks are regulated by the central bank. For Uganda, it is the Bank of Uganda that is regulating all commercial banks. So who is going to be regulating the Islamic finance? Of course, they will have their supervisory council. We need to know what are the functions of the Islamic council and what are they going to be, which kind of compliances do they need. Of course, they are complying to the needs of the Sharia law. That's where they are complying. They have to see that these banks, they are being given licenses, but they are operating in a sense that these are actually being regulated. Because someone can lie that we are providing Islamic finance, but they are not actually following the principles behind the Islamic products. So those are some of the things that we are going to look at. Detailed analysis of the principles. Then we shall also look at the advisory council, what its makeup should be, and what are the things that are supposed, what are they mandated to do. We are going to give a detailed analysis of those principles of finance, principles of Islamic finance. Now, one of the principles of Islamic finance is paying interest, paying or charging interest. Paying or charging interest is prohibited. Is prohibited. So the reason as to why it is prohibited or it's not allowed to charge interest is the fact that Islam considers lending with interest payment as an exploitative practice. Lending with interest payment as an exploitative practice. So given the fact that these people, they don't charge interest, it doesn't mean that these people are actually giving out money for free. No, their argument, we shall see how they treat these, some of the excesses that you pay and how it's determined. So for them, they are saying that lending with interest payment is treated as an exploitative practice that favors the lenders, effective practice that favors the lenders or the banks, that favors the lenders at the expense of the borrower. They favor the lenders at the expense of the borrowers. It's like they cheat the borrowers. That's how they look at interest. So here in Islam, interest is treated as riba. So for them, they treat interest as a riba. For example, if let's say a bank that has, because most of the times what happens in these banks, especially in developing countries where Islamic banks have just started emerging, what happens is that we always have a commercial bank or a conventional bank. That commercial bank, like we can use, let's say, Standard Chartered Bank, because I heard they have some window for Islamic finance. So if what happens is that the bank is going to have two windows, the Islamic window, then the normal business window. So this window is only going to be looking at Islamic products alone. and they are going to be lending out money not to Muslims alone. No, the principle operates even to those that are not Muslims. But the application of these principles, they are the ones that keeps the Islamic finance different from the conventional banking products. So what happens is that this side, they don't charge no interest payment, because they call the interest as riba. So this side we charge interest. The normal commercial banks, they charge interest on whatever amount that you've borrowed. But what these guys are saying, if you are that bank, because Standard Chartered Bank has two windows, the window for this Islamic finance and the normal retail and business trading business. Now, what happens is that you are going to have Islamic products, and you are also going to be having these other non-Islamic products. We shall look at the products. And those non-Islamic, or those other products that you are going to be selling to your customers, you are going to be charging interest. They are going to be charging interest. But now, what happens is the fact that if it can happen that maybe you have established your bank. Let's say we are going to go with the recent example, that is Salam Bank. Now, it's going to happen. There are situations where you may be tempted to have two windows, where you have the Islamic window and also the other side. I don't know much about the operation of this, but I know they are giving out Islamic products. They are Islamic products. I'm not sure whether they are actually providing two. But for a scenario whereby you are providing two items, it's going to be problematic in a sense that the board, if let's say you're a business and you want to go and borrow money, these people, the bankers, shareholders, they may be saying that for them they may be interested in just giving out Islamic products, but you are going to find that the kind of operation, it may not be sustainable for you to sustain the business. So that's why sometimes if the Islamic products, if a bank is running two products, it means the shareholders may be interested in having the Islamic products, but at the same time they are also having the other point of view. So this Islamic side is also going to be governed, or they are going to be using Sharia law to regulate its operation, that Windows operation. But now, if the shareholders entirely recommend that let the bank use Sharia law, even if you have two windows, but we go by Sharia law, what is going to happen is that the interest that you have made from this normal trade, which are not in the Islamic products, you are going to be forced to actually give out that money of the interest you charge, because they call it riba. It's not allowed. So if you charge interest, then the treatment, the regulators, we shall look at the regulators, they will make sure that you don't charge interest. So if you charge interest, that money you have charged in interest will be removed, or you will be forced to donate that money to charitable organization and other kind of people, depending on how. Most of the times they donate that money to the charitable organizations. So you may be having two windows, the Islamic window and the other window. The other window you may be charging interest, purely charging pure interest, the same way that these other conventional banks are doing. But what is going to happen if the shareholders of that bank are totally in agreement recommending Sharia law for their bank? Even if you have two windows, the interest you are earning from the other non-Islamic products, they are going to be sent out or donated to charitable organization because of the fact that interest is 100% prohibited. So that's what we refer to as the principle of charging interest being prohibited from the Islamic products. The other is just like how interest is prohibited under Islamic finance. We also have prohibited activities. Prohibited activities that even if they give you money, maybe you have received a bond from an Islamic bank, we have an equivalent for the bond. There is what they call it. We shall look at those types. If you borrow money from an Islamic bank and their regulation is actually using the Sharia law, then that money shouldn't be invested in these prohibited activities. So when they give you money to go and invest, then you are not supposed to invest in those prohibited activities. So what are some of those prohibited activities? One, we have alcohol. Maybe you're a brewing company, they can't give you money. Drugs, of course, drugs like narcotics, and others. We have also gambling activities. These people who operate betting companies. We have also pork, those that are involved in piggery, things to do with pornography, and others. These are some of the activities that are prohibited, that even if they give you the money, you are not supposed to invest the money they have given to you in those activities. So if you borrow money in any of those Islamic banks, you are not supposed to invest that money in prohibited activities. But you have to be careful. It could be an Islamic bank, but it is operating a conventional business, meaning they are not issuing Islamic finance products. So as long as you confirm that this business is actually separately providing products of Islamic finance and they are being regulated by Sharia law, then we can say that that money shouldn't be invested in those activities. So those Islamic banks, most of the times, those companies, most of the times they are in those Arab countries, Saudi Arabia, UAE, most of the times, because those banks, they are very big that side. And banks in those areas, they mainly provide Islamic products. But it's unfortunate in Uganda we have very few which have just started because of different aspects. And the reason is not because we don't want them to exist, but even the regulation itself. Of course, we are going to look at the regulatory authorities, but Islamic products, they are supposed to be supervised by a Sharia law council, of which we may not necessarily, like for a given country, they may not necessarily be having those people that can spearhead those kind of supervision. They can If you don't have those people, of course, we are going to be looking at what are the members, what are they supposed to be having. So if those people are not there, then you don't actually expect those businesses to run. And maybe that's the reason as why it took long to kick off in Uganda. But at least we have seen some coming up. So that's one way. And these prohibited activities, for them, they call them haram. That money came from drug, money came from gambling, money came from operating pork joints, pornography, alcohol. So they call that money, it's haram, because it came from the prohibited activities. So this haram is just an Islamic word. And I think even those who speak Swahili, this one must be just a meaning some in those that speak Swahili. If you know the meaning in Swahili, please just put the meaning in the comment section. But just know these are activities that are prohibited, and you can't use Islamic finance products to finance the activities of those businesses. So the same way, maybe we deal with the interest is the same way they deal with these prohibited activities. They are not supposed to be involved in those activities. Now, the other is no speculation. So Sharia law is strictly prohibiting any form of speculation, whether it is gambling, whether it's betting, with whichever, as long as something that involves speculating, you are not sure of the outcome, but you are doing it as a business. So they call it maisir. I don't know the pronunciation, but I think maisir, maisir, maisir. These are just words, but just get the meaning from the English perspective. So some of these, like I've said, for the betting companies, of course, they don't qualify, given the fact that their kind of work is more of speculations. There are chances, there are probabilities, you are not sure of the occurrence. So gambling and other kind of stuff. So there are also there is also a kind of speculation whereby the wholesalers, they buy products in large quantities and they hold those products. They don't sell them to the people, hoping that these prices will actually go up. So that kind of involvement is not allowed, because that's one way of speculating, because you are keeping the products so that you create scarcity and you'll be able to sell as far as the price has gone up. So that kind of speculation, where the thing of trading, forex trading, you anticipate maybe the dollar will move up, you buy, then you keep selling. Those kind of business, those are speculative businesses. So speculation is not allowed. They call it maisir. So what is going to happen is that most of the time we say, remember, these are going to be cases. They may mention these words, maisir, in the case, haram, riba. So you just have to know what they mean in English. Then you'll be able to explain. You are not supposed to explain in Arabic. But as long as you understand what it means, then you can be able to explain basing on the scenario that they have given you, because you may find this in a scenario or in a case study. So you have to just know what it means and you explain, and that's all. Therefore, these Islamic financial institutions cannot be involved in contracts where the ownership of goods depends on uncertain event in the future. Just like these things we do in accounting, because most we account for option contracts. Those, when you're dealing with the futures, those things, they are not allowed. We shall look at these option contracts and futures maybe when we go to the other side of hedging interest rate, hedging some. That's where we shall look at some of those different aspects, because those that are going to be involving predicting, because you can have a contract and they are telling you maybe you are buying goods from outside, overseas, maybe from Japan, raw materials, and you are not supposed to pay in Ugandan currency. Maybe you are supposed to pay in a dollar currency. You can fix the dollar, that I'm signing an agreement. By the time you ship these products and they come to me maybe in 4 months, I will be paying you at this fixed rate of the dollar rate, the currency rate. Because if you don't do that, the dollar may keep on changing. You get an order and they tell you the dollar, you are going to pay maybe 20 million. But due to exchange rate, you find that by the time the goods come to your side, currencies have increased and you are going to be paying more money than what you should have paid if at all you had to pay at the time when you made an order. So those kind of hedging, those kind of risks in forex, those are more of speculation. So these kind of things you are hearing me talking about, hedging, things to do with the option contract, they may give you a scenario and it is just talking about those. Then they explain, they tell you to identify the principles, but they are just giving you examples of these. So the case is going to be rotating on some of these aspects. So the things to do with the hedging, we shall learn more about it. We shall do hedging and we shall see how we hedge against some of these risks. And some of the tools that we use, those are the ones that we call futures. We have what we call the swaps. We have traded options. We shall look at some of those and others. So therefore, these are more like speculations, and we are not, because you just keep on fixing and you are not sure of what will be the outcome. So those kind of scenarios, they are not allowed, because you are not going to be sure of what is going to happen by that time. So you are just hoping by that time, maybe if I come up with this contract, then this is how we shall manage the risk, etc. So such aspects or such activities are not allowed in Islam. Then we look at the other we have uncertainties and risks is also another principle. And the rule of Islamic finance banned participation in contracts where the terms and the subject matter are uncertain. They tell you we sign a contract, maybe we expect that maybe we are going to win. You bet. So when the terms of the contract and also the subject matter, there's something that you are putting your money against, is not sure. You are going to borrow money, but you are not sure whether you are going to make a profit or you are going to make a loss. The subject matter is not clear. So if it is uncertain and it has excessive risks, then this is also going to be prohibited. This aspect of uncertainty and risk includes prohibition on selling something that's like you try to sell something that you don't own. You are selling something and you don't actually own the thing. Like those things we do, like the things that we do in accounting, these derivatives, which are more like gambling, where you are involved in trading something even when you don't own it. Even there are these brokers who actually advertise that they are selling land when they actually don't even have the land, but they are just connecting people. I know the other one is selling, so let me get the buyer. That kind of activity. And you tell the buyer that the property is actually yours when it is not actually yours. Those kind of transactions, they are the ones that because you are not sure of the event that is going to come out. So the other principle of Islamic finance is that risk should be shared. Risk should be shared. Of course, we are aware that in business, even the Islamic banks, they are aware that in business there are risks that are involved. Therefore, in Islamic finance, the partners will share the profits, and at the same time they will share the losses according to the part they played in the business. If we come together and we do business, we make a loss, we share that loss in the way that we became part of that. What, like you share what you contributed according to how you contributed to that loss. But we are not supposed to say that we are going to be sharing these losses equally. No, we share according to our participation, if at all that is a business. So it's according to how you are in the business. If I bring in capital, if I'm the bank, I'm the Islamic bank, and I give you money, you make a loss, there is no way you can tell me that we are not going to share losses, because I didn't borrow your money to actually go and make losses. The intention wasn't to make loss, but I made a loss. It's different from the conversion. The other side, the commercial banks, if you make a loss, it's your loss. For us, we gave you our money, return the money. But now these ones, they also add in something that they don't have guarantee on returns. If you come together to do business, then there are possibilities that you may actually not get the profit. So there is no guarantee that you are going to earn a profit. So no guarantee on the returns. Therefore, there are risks, but of course they recognize the fact that there are risks that are going to be in the business, and they are going to be shared between the lender and the borrower. For example, if let's say I have lent to you, if the bank lends me, let's say 20 million, if they have given me 20 million, and maybe for me to go and invest in, let's say, a bookshop, but before the bookshop starts, the money is stolen. Before I start even doing anything, the money is stolen. So what will happen according to Islam? The risk must be shared, because I never intended to actually let this money be stolen. So the money, the loss will be shared. And at the same time, if we start a business, if at all money is not stolen, I've started a business and I've made a loss, then that loss is also supposed to be shared, because my intention for me to join business wasn't to make losses. So you shouldn't penalize me because I've made a loss. So that's why they are sharing these losses. And if you make a profit, then it's also going to be shared. It's like it's more of a partnership. So the logic here is that when money is stolen or the company has made a loss, the loss must be shared because no one expected it to happen. And that's why they were restricting us from investing money in those uncertain activities, so that we invest in legitimate trade, legit, something you are sure you are not just throwing money, and that's why you can be able to benefit. But there are scenarios that I can give you money and you invest in those prohibited activities and you expect us to share the loss. That won't happen. So that's why they are saying you share the loss based on how you involved. If you're the one who actually made that loss, or maybe you are the one who stole the money by yourself and you start saying that the money was stolen, then it will be upon you. Now, the last one that I want to look at is the other principle is wealth must be generated from legitimate trade, and it's supposed to be asset backed. It's supposed to be backed by an asset. So they are saying that wealth must be generated from legitimate trade, and it must be asset based. It must be asset based investment. In other words, we don't have money on money transactions like what happens with the lenders. They give you money and you go and do any business you want, then you bring back their money. No, these people, they tell you, if you want to buy, if I'm borrowing money to buy a car, it will be the bank to go and pay the bond owner, the car owner. Then they give me the car. Of course, they pay the other car, they buy for me the car, and they give me the car, then I start paying money. But I'm going to be paying the amount that they have spent to buy that car. Secondly, we may agree to add in some extra amount just to take care of the administration costs that are going to be incurred. But that is going to be on agreement that I'm buying for you a car of worth, let's say 50 million, but in return for you will be paying 55 million for a given period of time. So you will be paying that knowing you have agreed and you have accepted that the other 5 million is coming in to just necessitate the operations of this business. But it doesn't necessarily mean that these guys are going to give you 50 million and you give them 50 million back. No, that's not how it works. But that's how it seems to be, because the other cost that they are going to charge you is like a nominal cost. They add in that just to cater for these extra expenses that may occur, because they can pay a motor vehicle for 50 million. But remember, there are other paperwork, transferring the logbook and other costs. So you'll find yourself on top of the 50 that they have paid the car owner, you will be ending up paying more, but that amount is supposed to be agreed between the two of you. So therefore, those are some of the principles that we are going to see here. So I want us to look at the regulatory framework for Islamic finance. We look at how it's going to be regulated. What are the parties that are involved? The regulatory bodies for Islamic finance. So this has never been examined, but at least we need to have it in mind we need to make sure that at least we can be able to understand what we are doing. But you have to take note. As I said, I'm presenting it in the same way it is supposed to be taught as of level 2 financial management paper, because they revised what was on level 3 and they took it to level 2. But the examiner has a right to pick from the concept that we studied from the financial management paper that's on level 2. That's why I'm taking it from the very basic point of view. So, but I'm going to highlight the things that we were supposed to cover as far as Islamic finance for advanced financial management is concerned, because there are very few basic things that we are supposed to pick, with the assumption that most of the things you studied them in the financial management. In other words, we have got two regulatory bodies that regulate Islamic banking. One of them is the accounting and auditing organization. Accounting and auditing organization for Islamic financial institutions. That is abbreviated AAOIFI. And this was established in 1991. Of course, as I said, this Islamic finance is more in the other side, the Arab countries. So it was established in 1991 in the Kingdom of Bahrain. And it is the one that prepares. Its role is actually, the role of this is to prepare. It prepares accounting, it prepares auditing, it does governance, it does also providing the ethical and Sharia standards. That's what it does. So this body, the AAOIAI, that is accounting and auditing organization for Islamic financial institutions, has issued, so far it has issued over 56 standards, and it has membership spanning to 28 countries. Of course, as I said, this keeps on changing. So members keep on coming with over, of course, it has over 110 institutions. And in Uganda, as I said, we have, of course, even these, they keep on increasing over time, because just like in Uganda, we had no Islamic bank, but now we have that Salam Bank. So you can see they keep on evolving. So that's the first body, or first regulatory body, that prepares the accounting, auditing, governance, ethical, and Sharia standards. So the second one, of course, now we are looking at the international one. The second one, the other body that is regulating Islamic finance is the Islamic Finance Services Board, IFSB, Islamic Finance Services Board. So now this one is setting, it is the body that helps to set standards. This is a standard setting body, and it is based in Malaysia. Based in Malaysia. The place is, that is the place. I don't know how you read it, you pronounce that, but what I know, it is in Malaysia, and you've said it has over 110 members, and these 110 members, they include regulatory, some of the regulatory bodies, like of course the IMF, International Monetary Fund. Of course, IMF will not miss, World Bank will not miss. Of course, even the Islamic Development Banks, Islamic Development Bank. So most of those are the key international bodies that are responsible for regulating the operations. So even these banks, they are supposed to be compliant on those standards. They have standards on how they prepare their own staffs. So we want now to look at regional basis, regional regulators. We look at, depending on where the bank is, if the bank is in Uganda, if the bank is in Nigeria, what are the regulations that are there? Now, I want to look at other regulations, but these other regulations, they are local regulations, or that are on a country level. These are international regulators. So let's look at other regulators, other regulatory framework. Now we are going to base on what is happening in Uganda. What are some of the things? Now, the new syllabus, it's talking about regulatory framework, and it points out the following. But what it points out, you'll find that it's taking most of the financial institutions. So let's look at what the syllabus is talking about. These are locally, or they are countrywide. So we have the Financial Institutions Act of 2016. Of course, this is for all financial institutions. Financial Institutions Act 2016. This one, its role is it governs all financial institutions in Uganda, and it is the one that is providing regulations of Islamic finance. Number two, we have, of course, when there is an act, expect there to be a regulation. You know, the act is always brief, but the regulations are always detailed. These regulations, they are the ones that stipulates, or they are the ones that give detailed analysis of what the act is actually meaning. So we shall also have the Financial Institutions Regulation 2018. But this is basically Islamic banking. Then we have also the Insurance Act of 2017. Insurance Act of 2017. We also have TACFU regulations. So these are some of the regulations that are available locally. So you can check out some of these things, like the Financial Institutions Act. That one you can download and look at it. But it is governing entire financial institutions in the country. So you can download whichever you can download and have access. You see what they talk about. And this is what they are doing. Of course, in the for examination paper, they are not going to ask you so many things. They're just going to, if the question happens to be on these regulatory bodies, it's going to be asking which regulation and what does it do. It does what as far as Islamic finance is concerned. But just know, as I said, that Islamic finance is not all that something that it has been there for long in Uganda. But that doesn't scare the examiner from examining it. So you just need to know what it is and what it talks about. Just a brief statement of like 2 lines of what it talks about in regards to Islamic finance. Just like the way we said that the Financial Institutions Act of 2016, it governs all financial institutions. So whether you are going to be an Islamic bank, you are also a financial institution. So you are going to be regulated by that act. So that's what we are basically going to be talking about. So it's, as I said, it's a new area and the examiner is talking about it. So we need now to see if there is anything to do with corporate governance. Now we need to look at the corporate governance. Corporate governance in or under Islamic finance. Under Islamic finance. We haven't started the topic for corporate governance and ethics, but we want to look at how the institutions are going to be managed. Because corporate governance is all about managing the organization, and that's it. How the organization is managed. So since it is an institution, it's supposed to have corporate governance is supposed to be there. For any institution, if you don't manage it well, you'll find the organization is going to be collapsing. So we are going to look at some of the things that we are going to be looking at. We are going to be looking at the Sharia Supervisory Board. So want to understand, because it will be the organization that is going to be looking at how the organization is supposed to be. It's the one that's supposed to guide on the entire operations of the business. So the Sharia Supervisory Board is what we are going to be basically focusing on. We see its roles and we see the roles, and also we see the members. What are some of the members that are supposed to be part of that Sharia Supervisory Board or Sharia Supervisory Council, whichever they call it. So when we talk about corporate governance, it's all about how the institutions are directed or managed. So in Islamic banking, how do we provide guidance? And that's basically what we are trying to look at. How do we provide guidance? So there are different bodies, but I'm going to focus. There is what we call the Sharia Supervisory Board, abbreviated as SSB. Sharia Supervisory Board. And the examiner will ask you what are the functions of the supervisory board. So before we look at the the composition. Let's first understand what it is meant to achieve. Because the functions, they may be in terms of the roles that they. So let's first look at the roles of the Sharia Supervisory Board, that is SSB. Now, one of the laws or the functions, it it does the review and certify the permissibility of all contracts. It's the one that does the certification of those different contracts. They may be contracts or documents and even the products to see whether they comply to the Sharia law. So they do the compliance check to see whether those are actually complying. Number two, they confirm the existence and compliance level of the practices to Sharia laws. In other words, they look at what these banks are doing, the Islamic banks. What are they doing? Are they in line with the things that are supposed to be done? Are they doing the right thing? That's what we look at in terms of confirming that if, let's say, they have given out money, are they following up to the people that they have given money to confirm that they are not investing that money in, let's say, prohibited activities? Are those banks not charging interest? Because we say the interest is not allowed. So they do the compliance, but they are complying upon the principles that we stated earlier. 3, they also advise. So they do advising and monitoring the manner of disposing the non-Sharia compliant earnings. I told you that you may be having a business, but the bank is having both the interest loans and also the Islamic products. So if the shareholders, they are relying on the Sharia law to look at the operation of the business, then the interest that they are earning from the non-Islamic finance products, they are supposed to be disposed of. How they dispose of it will be the supervisory council to look at, are they done the right thing? Because you may say we are disposing of the interest you've earned through extending loans by keeping the money somewhere in your secret deposit accounts. But they have to confirm that if you are saying you need to send the money to a charitable organization, the fact is, are those guys receiving the money? That's what we are calling advising and monitoring. Because they tell you that maybe basing on the need that is available in the given location, you maybe try to donate that money maybe to the elderly, maybe you try to construct hospital, to buy Qurans for different mosques and others. So those are some of the kind of ways, but they don't just, even when they are earning that interest, but it all depends from the fact that the shareholders of that bank are willing to actually declare that they are following the Sharia law than the normal conventional banks, what they do. The other is also issuing a Sharia compliance report. Of course, after they are advising, they are monitoring of the activities that are done by several institutions that are following the Sharia law, they have to give a report that based on what we found out, maybe we found maybe such and such organizations are compliant. In terms of, they're like more in terms of auditing. You audit based on the activities that these businesses are doing, whether they are compliant with the Sharia law. So they issue out those reports based on the company's operations. Of course, the compliance reports, these reports are going to be certifying that all the transactions comply with the Sharia law. Certifying that all transactions comply to the Sharia law. Then the other, we can also look at, they can conduct and arrange trainings with different, maybe with the management of these banks, to actually equip the employees with the relevant knowledge as far as the products are concerned. Conduct and arrange for training. They conduct trainings and others. So let's now try to look at what are some of the forms. Let's focus on the forms, all the types. No, those were, but before we look at the types, let's first finish off with the composition, because we have not yet looked at the composition of the Sharia Supervisory Board. Composition of the Sharia Supervisory Board, SSB. Now, the composition is basically what are the kind of people that are supposed to be in that board. The composition, it's in terms of the membership. We look at the qualifications of these people, because you can't just take anyone. We are supposed to have certain people with the relevant information. Of course, there are those that are mandatory that are supposed to be there, like lawyers. Of course, those are obvious people, but at least the lawyers should be in understanding of the Sharia laws. So, Islamic banking requires establishment of Sharia supervisory board. In other words, if, for example, if let's say one of these banks, these commercial banks, let's say Centenary, they want to introduce maybe Islamic finance banking, then there must be an Islamic supervisory board to make sure that the flow of the information, like they keep on following up on what is done by these banks. They follow up on the business to ensure that these businesses are carried out in line with the Sharia principles, or the Islamic banking principles. And those principles, they are the ones that we talked about generally. Because, as I said, you may, as a business, you may pretend that we are actually giving out Islamic products, but yet in actual sense, you are not following any of the Sharia principles or the Islamic banking principles, like not charging interest, doing maybe engaging in prohibited activities, and others, which is not the case from the other side of the conventional banks. So they have to make sure that they comply with the Islamic principles. Now, the examiner has ever asked the composition of the Sharia Supervisory Board. And one of the people that's supposed to be there, we must have religious scholars. Religious scholars. We must have lawyers. And these lawyers, these lawyers must understand the Sharia laws. They must understand the Sharia laws. We should also have economists. Of course, there is no way you're going to miss an economist, because it's going to be an area where you expect to have something, to have an economic benefit. So you need economists and others. And the roles of these people is actually to direct. Their roles are to direct. They are going to direct, review. They are going to be directing, reviewing, and also supervising the activities. The activities to ensure that compliance with the Sharia laws and principle is achieved. So, you may find that you are introducing an Islamic product, but people are taking the money into prohibited activities. Remember, with the Islamic products, we say that those they are not supposed to be invested. The money that you have gotten is not supposed to be invested in those prohibited activities. And the other thing that you need to note is the fact that these Islamic products, they are not going to be for only Muslims. No. As long as these people, they are not going to invest money in prohibited activities, as long as their investments and all the activities are going to be following the principles of Sharia laws, they take the money. It's not basically that it is there for only the Muslim people. It's not for that community alone, as long as there is compliance. So these are some of the people, the religious scholars, the lawyers. Of course, we can have accountants, auditors, economists, and others. But the religious scholars, they are the ones that are very important, because they will be the ones to do more of the interpretation. But even the lawyers themselves, they must also be equipped with an understanding of the Islamic principles and Sharia laws. Even the accountants, because we said that they have an accounting body, they have even their accounting standards. So if you want to be in that kind of past business, you have to be able to understand how they operate, even when you are doing their audit. So one of the things they do, they are directing, reviewing, and supervising the activities of the entities to ensure compliance with Sharia laws and principles. The other thing that they do, they also undertake Sharia audits. Of course, here we have also accountants, but they are supposed to be in line with the audit, and any income that is not Sharia compliant is supposed to be given to the charity organization. It's not that they are not going to be having those kind of activities, but if money comes out, it's supposed to be given out to the charity organization, or it's supposed to be donated for charity events. So if they discover that these products generated revenue, or they generated income that is not Sharia compliant, they insist and actually verify that they give it out to the charity organization, whichever advice that they have provided. So the board also is supposed to have, so these are the religious scholars, the lawyers, and then the economics. For them, they are more in the reviewing and the supervision for compliance and even doing the audit. Then the body should also have, they should have at least, they should have a minimum of 3 Sharia scholars. Now we are looking at the breakdown. Sharia scholars, at least a minimum of 3. And that's one of the reasons as to why these products are not taking place in most of these parts of Africa, because the people to get these Sharia scholars, most of the times you find maybe the qualifications can't be met by those who want actually to be. So that's why sometimes it takes long for them to adopt such kind of businesses. But the good thing we are seeing that in Uganda, we have gotten some few banks that have started operating the Islamic financing or Islamic banking. So this question was also examined in December 2020. Question 1, part E. So as I said, these questions, they are there. Once you get this, you get the key roles and also the composition, then we can look at, maybe we can focus on the forms or the types of contracts in Islamic finance. In other words, these are the Islamic products. The forms, stroke types of contracts. They may be contracts or products. They are contracts, but we also have some contracts in Islamic finance. They may call them Islamic contracts, or sometimes they may call them Islamic, let me use a different color. They may call them Islamic financing structures. So we have also a reference question for this. It was in March 2022, question 1G. So we have some, I'm just going to outline them, then we shall look at one by one in detail in the next video. So number one, we have Mudaraba. These are partnerships. They are more of partnerships. We have Musharaka, and Musharaka is more of equity partnership. We have Sukuk. Sukuk means it's just a bond, Islamic bond. We have Ijara. That's a form of a lease. It's a lease arrangement. Then what we have, Murabaha. That's just a form of credit sale. Then we have some other contracts like salam contracts. We have Wakala, they are called Wakala plus H, I think plus H. Wakala. There are very many. Or there is even institutional contracts. There are also what we call a twalik. Let me use a different color. Twalik. So we are going to look at each of these in detail, but we are going to find that in the next video. Hello viewers, welcome back to our episode on advanced financial management, and today we want to look at the different forms of contracts or the Islamic financing structures, and we want to look at some of those that we had previously outlined in our last video, and we make sure that we give a detailed analysis of each of these different products that we have under Islamic finance. So the forms. So one of the forms we have what we call, can start with musharaka, and we said musharaka is a form of equity. It's more of equity partnership. Now, we want to understand what this is all about. Now, this is more of a joint enterprise or a partnership structure where at least two or more parties bring in capital and skills. One person is to bring capital and the other is bringing the skills, and they want to trade in non-prohibited activities. So we have two or more people, one person here and another person this side. This one is going to be bringing capital, and this one maybe is going to be bringing skills. In terms of skills, we are talking about managing the business. These people, they can come together, they form a group. Maybe this is Charles and maybe this is Ivan. So they can form a partnership group, maybe CI partners. Then this one can be the one to manage the business when this person has just brought in the capital. So one brings in capital and the other is supposed to bring in the skills. Because most of the times you may find that some people have the knowledge of how to do certain things, but they don't have the money to begin the business. Others have the money, but they don't have the skill that they can use to be able to do the work themselves. So what they do, you come together and then they start doing the business as two people, but one has brought in capital, the other has brought in just skills. Even the way they are going to be sharing the profits is going to be a little bit different. But the bottom line is the fact that we have one or two or more people coming together. One must be bringing capital and the other is bringing skill. That's the differentiating feature. They come together and they do business. So in this case, finance is provided by, at some point it may also happen that this person who is providing skill, maybe he has some small amount. He can also bring in some small money. Let's say he's going to be bringing in something like 20 million, maybe the other one is going to be bringing 50 million. So the whole lump sum capital is going to be 70 million. But on top, this person is actually bringing in, on top of the 20 million he has brought, is actually bringing in some skills. So they can come together and they start operating. So in this arrangement, if you find that everyone is going to be bringing in money, you find that both of them are going to be bringing in money, and at the same time both of them are going to be involved in the management of the business, then we call that mushariki. These terminologies, mushariki, because everyone is bringing in cash and everyone is going to be engaged in the management of the business. Now, we want to look at the situation. How are they going to be sharing the profits, or the profits or losses, whatever they have achieved at the end of the period? So profits is going to be shared in a pre-decided ratio, and losses is also shared in the capital ratios. In other words, you look at the ratio. If this one, maybe this person has brought in, this one has brought in 20 million, the other has brought in 50. So the ratio is going to be 20 to 50. And that will be 2 to 5. That will be the ratio for sharing losses. Losses are going to be shared in profit contribution ratios. But when they are sharing the profits are going to be shared in a pre-decided ratio, or a predetermined ratio. So they determine based on whatever basis they have used. But what is key is for the loss. The loss should be shared in their capital contribution. So, whereas it is a joint partnership, even when you are providing management skills, you can bring in some money, because you may totally say that me, I'm not going to be having money, I'm only going to be contributing in terms of bringing in the skills. So if you are bringing in the skills, the argument is that you will not be sharing the losses, because losses are supposed to be shared in the capital contribution. If you contributed nothing in terms of capital, you are not sharing profit, you are not sharing losses, you are only there to share profits. Because there is no way we would say that we are going to penalize you for not managing the business well so that you can be able to make profit, because you sacrifice your skills to be able to make a profit, but you didn't make it. So if at all we have a loss, why are we charging you? At the end of the day, you had nothing. So that's their thinking, and it's a little bit, it's in that perspective as you can see it. So you are partners, but the losses are going to be shared in the capital you have contributed. So if you have brought in maybe 20 million, the other has brought in maybe 200 million, whichever the amount. But on top of the 20 million that you have added in, you are also bringing in the management skills. Then the other person may only bring in capital, because the other person can only say, me, I'm not going to be available. He brings in the cash, he says you manage the business. You bring in some cash, he brings in cash, but it's you who manages the business. So once you make a loss, you share in the profit. You share the profit in a given ratio that you have agreed. But when it comes to a loss, you share in the capital ratio. So this is a little bit different from what happens from the conversion, these commercial banks that we know. Of course, for the commercial banks, as long as they have given you their money, whether you have made a loss, you have to pay. You have to pay them. Whether you have made profit, whether you have made losses, you have to come and pay their money. But for Islamic finance, they are saying, as long as you brought in skills, even if you have not brought in capital, when you make a loss, you are not supposed to share to be part of that loss, because otherwise you committed yourself by providing the skills that is needed to actually come up with business ideas that you can do with the intention of making more profit, because you had nothing. So there is no way they could be deducting money that you don't actually have, because in the first place you joined minus any money, which is a bit different. So that's what we have as musharaka. So I want to go to the next one. We look at what we call the mudaraba. Mudaraba is also partnership. It's also a partnership arrangement. But we want to understand how is it different from musharaka. Now, it's also a partnership transaction where one party supplies money. Now, this person is only going to be bringing in, we can have two people. We have two people. This one is bringing in 100% capital. Is the one who brings in capital. This one is bringing in 100% labor. This is just bringing in skills. Doesn't have any money. Now, what happens is that the person who is going to be bringing in money, the supplier of money, is what we call the Rab Arma. That is the person who supplies money. And the other person is what we call the Mudalib, the one who supplies labor, Mudalib. So this person is only bringing in labor. So now what's going to happen is the fact that these two people, this one is bringing 100% capital, then this one 100%. The Mudalib is bringing 100% managerial skills. And now the partnership is mainly between two people, and it's called a Mudalaba contract. Now, when these two people make profits, profits are going to be shared in a predetermined ratio. Predetermined. In case of profits, once they have made profits, they are going to share in a predetermined ratio. They can agree on whichever ratio that they are going to use to share the profits that they have made. But now, in case of a loss, the loss is supposed to be 100% on the person who brought in the capital. The loss is supposed to be bared by this person, the Rab Arhma, the person who brought in the capital, is the one to suffer all the loss, because this person brought in nothing, because he had nothing. He sacrificed his skills and he put in the business. And the business, he didn't get any money, because when you don't make any profit, you don't expect this person to have anything, because at the end of the day, he brought in nothing. He just brought in his own skills. So if he has tried his best and he has not been able to be successful, there is no way you are going to say that the loss that I've suffered, because this person is going to be managing 100% of your capital, they will only be liable if at all they are the ones who led to that loss. Maybe they stole the money themselves, then they will be liable to pay. But if they have done everything in their powers to actually be profitable, but it never came out as a profit, then they are not supposed to be penalized for the loss that they have made. So we need now to get the difference between Mudaraba and Musharaka, because Musharaka is also a joint venture, but Mudaraba is specifically for two people. One is bringing in capital, the other is bringing in labor. Two people. The other one can be two or more people. But one, the two of them, each of them has to bring in some capital. This one can bring in like 20, the other one brings in the more, maybe 500 million, this one brings in 20. But on top of the 20, it provides skills. So I hope you are seeing the difference. So the other one is committing. In Mudaraba, one person is committing 100%, providing managerial skills with no money. But the other one is also providing 100%. He is not supposed to interfere into the operations of the business because he's the one who has provided a capital. It's like the bank giving you the money and you go and start operating. When you make a loss, because the bank wasn't there when you made a loss, but if they go through into the causes of the loss and you are part of the reason as to why the business made a loss, then you find yourself paying. But if they find that it is 100% clear, you did the right thing, but things never came up, then you're not supposed to make any payment for the losses that are incurred by the business. And even this person is not supposed to, of course, pay you any contribution because you didn't make any profit. So that's the difference between those two items. Let's look at the third one, which is skook. Skook. We said skook is a lease arrangement. Skook, we said, is a lease arrangement. Skook. Sorry, skook we said is a bond. The lease is the other one called ijara. This one is a bond. Sorry about that. So these are Islamic bonds, and these bonds are structured in such a way that they generate return to the investors without infringing the Islamic laws. Of course, these are bonds but these bonds have no interest. In other words, you will not include any interest in these bonds. Remember, the normal conversion banks, those commercial banks, they charge interest on these bonds. But for the skook, it will be structured in such a way that there is no interest. So the bottom line stuff here is no interest charged on the bond. No interest is charged on the bond. Now, what is the aim? Because if you are not going to have any interest, so what's the aim? So it aims at profit sharing by offering the investor or the owner, the person who is investing the money, is getting ownership into the business. The profit sharing is in the sense that I can give you the asset, only that you are going to allow me to be part of your business. You can be, maybe you are looking for, you want to construct your production factory, but you don't actually have the money. I can construct for you the factory, then I will be part of the business. I become part of, like we'll be owning the business together. And when we are owning the business together, it means we are going to be sharing the profits that we've made from using the manufacturing plant that I constructed. So the motive is just to share profits. In other words, you include the investor in your business or in your asset, because It could be a bank. I don't have the money to construct the factory plant. Then I go to the bank. The bank buys for me a building. Now the building is going to be mine. But since those people, they are not going to be earning interest, what they are going to do, they are going to make sure that they are part of the business, that the profits we've made in the business, we are going to be sharing them. If it is just an asset, if you are not in business and maybe it's me, I just want to go and buy land for myself, they can pay for you the land, but they are part of that land. Meaning whichever benefit you derive from that asset, you are going to share. Whether you buy the land and you leave it there for capital appreciation, it's not a problem. But the moment you want to say that you are selling it, just know they are part of that asset. So when they are buying, the asset is going to be like it is for two people. That's what we call the sukuk, the bond. It is structured in a sense that we don't actually pay interest. So whoever provides the money or whoever provides the bond, remember, for you, you provide a contract. And the owner of the money will give you the right to own shares in your company or in that asset. But what happens in the other commercial banks is that what they do is a bit different from what they do here. In these sukuk bonds, these are going to be linked to underlying tangible asset. These are basically on tangible assets. You are supposed to have a physical asset that you want to acquire. The asset is supposed to be there. So that's why for them they were saying that wealth is built on asset-based investments. So for example, it could be a bond that you are either, maybe you are going to buy land or build a school. Therefore, the provider of the money must own. So, as you know that a bond is just a promissory note or a document which you can give out, or that the one they provide so that they can be able to receive money. And once money is received, then the provider of the money will wait for you to pay with the interest from the other commercial banks. But with the sukuk bonds, if the sukuk bond is, say, 50 million, then the next question that you are going to be asking is, what is it for? You want this money for what? Either buying land, building, machine, as long as there is a physical, tangible asset, then the money will be paid directly to the owner of that land. What is going to happen? The money is not going to be given to you, because when they say there must be a tangible asset, the implication is that I want 50 million, but you want it. What do you want that money for? I want to buy land. They don't give you the money. They just buy for you the land. In other words, there must be a physical asset that you are acquiring. If you want money to construct a school, then the bank will just construct for you the school. You just tell it where you want to construct the school, and they analyze everything to see how much is needed. They do the construction, or they pay the contractor who is going to be, so that there is an underlying asset And that's why they are saying the money is backed by assets. So once they buy for you this asset, just know that asset is going to be owned by two people. And that's how it's going to be. No one is going to take it back. No, but you will be sharing profits that you are making from the use of that asset. So let's look at the other ijara. Ijara, we said, is a lease contract. An ijara transaction is the Islamic equivalent of a lease, where one party, which is the leaser, we have the leaser, is going to allow the other party, who is the leasee, to use the asset against payment of what we call the rental fees. You'll be making either monthly or annual payments, and it's a mode of payment. But the bottom line is the sense that without interest, you will be paying rental fees, but without interest. And if you include interest, then the principal would have been killed. Then it wouldn't be an Islamic property. So when they are designing these rental fees, because someone is going to be asking, how do we benefit as a business, or how do businesses benefit, those banks benefit from these kind of transactions? Now, what happens is the fact that they may tell you that you are going to be paying maybe 20 million. That's the amount that you are going to be paying. But you agree that the two of you agree that instead of me paying maybe 20 million, I'm going to be paying 22. And you agree. Meaning the difference will be the income that the bank will have earned, so that they can keep operating. Of course, that 2 million will be, in a normal sense, it is an interest. But they don't call it an interest because it's not an effective interest, because it's in agreement. The two parties come together and they agree. But remember, the interest is always provided for. The central bank provides the interest rate. So that's why they are not calling it interest. But they sit and they agree and they see which amount that this person is going to actually add in to cater maybe the monthly monitoring fees. So they will just call it maybe monthly monitoring costs that are not basically the actual interest. Then we look at the other one, murabaha. Murabaha, we said it is a credit sale. So here, they sell to you goods on credit and you pay later. So a murabaha transaction is basically a deferred payment scale, or it's an installment payment, either hire purchase, something like that. So as long as they give you the goods on credit and you are going to pay later, that's murabaha, and is mostly used in purchase of goods for immediate delivery on deferred payment basis. So in other words, you buy the goods, they give you the goods, but you don't pay the money there and then. It's different from where you order a car, then you wait for it to first reach, then you make payment. No. This one, they deliver, immediate delivery is supposed to be made. You buy the goods, they have delivered to you, you sell, then you pay back. Or you buy, then you keep paying in installments. In other words, if let's say I'm a construction company, it will come through maybe from the construction companies, and I need maybe 100 bags of cement to construct a building. Because you're a construction company, you have contracted a building, but maybe the owner has not actually paid you the money. You can pick cement from a factory, you use the cement, then after the building has been constructed, this person pays you, and you also go and pay the other person that supplied to you goods on credit. It's the same that even the manufacturing process, whereby you get the raw materials on credit, then you pay when you have gotten money. So we can also look at what we call the salam contracts. Sometimes they write salam as this. So just understand what they are, and you base what they have given you in the exam. But that's what we are looking at. These are just contracts which are similar, like those forward contracts. Shall look at what forward contracts are. But just know these are also similar, like to those of forward contracts. Forward contracts. Now, we shall learn more about the forward contracts. But these forward contracts, most of the times we use them to manage foreign currency issues. In other words, if you realize that the exchange rate is fixed today, let's assume that maybe the dollar is 36, the dollar rate to UJX 36 shillings. If you realize that this dollar is fixed today, and you expect that the dollar might keep on changing or it might increase, then you can sign an agreement that you will be making payments at this dollar rate, fixed dollar rate. Because I may be demanding you maybe 15,000 US dollars. By the time you will come to pay me, the dollar rate, I was demanding 15,000 and the dollar rate was 36. By the time you are coming to pay me, the dollar rate has moved maybe to 38. Are you not seeing that you are going to be paying a lot of money? So you better sign a contract saying, I will pay you at this dollar rate of 36, such that when you multiply this times this, you will be paying that equivalent. But if you don't sign any contract, meaning you will be paying at this rate, where you will be making a loss, because you will be paying more than what you would have paid. So those are the forward contracts. We shall look at how we do some of those and how we can be able to manage losses, because this one would be good for the business that is receiving money. But just take, for instance, if you have people you have supplied on credit and they are paying you when the dollar rate has reduced, you gave them goods when the dollar rate is 38. Now they are paying you when the dollar rate is 36. I don't see that you are making a loss. So those are the forward contracts. We also have what we call the wakala, the istisna. These istisnas, for them, they are just long-term. They are long-term in nature. Those large-scale construction, the wakala. So there are very many aspects as you can look at. So the mulabaha is just, and today we want to look at a new topic. We finished our Islamic finance, And as I had promised you, we are going to start on ethics and corporate governance. So the new topic that we are going to look at is ethics, and corporate governance. Corporate governance. Ethics and corporate governance. Now, we are now going to go into the details of what ethics is. Of course, we are going to understand what ethics is. But anything you know from the basic point of view, ethics, we just take it as anything that you know you are doing, but it's not morally, it's not morally right. So anything you do, but you know it's not morally right. You know something can be legally right, but it's not morally right. Like for instance, we may be having loopholes within the laws, and someone is going to use those loopholes to either deny a service. Like for instance, someone can use the loopholes within the laws to actually avoid paying taxes. Someone can use the loopholes within the laws to actually commit something that is not moral right. So ethics or ethical issues are those issues that you see. They are supposed, they are the normal behaviors, they are things that are believed to be true, even though legally they may not be right. Like something that is morally right. Now, when we are studying ethics, we take it from the unethical issues or the unethical behaviors, because those are the ones we don't want. Ethics is good. We saw the reasons in level 2. We saw the reasons at why companies should operate ethically. They should, one of them, they can attract employees to come and work for them. They don't have legal fees that are going to be paid when they are committing crimes and all that kind of stuff. So they are going to be, if you operate ethically, you are going to reduce the chances of you finding yourself in court cases every time. So we want to understand ethics, but ethics, if you want to get it, just get it from the basic point of view, that anything that you do that is not morally right, then it will be regarded as unethical behavior. Unethical behavior. We always look at it from the unethical point of view, because that's what we don't want. We don't want people to be doing. Now, when it comes to corporate governance, corporate governance, here we shall be interested in seeing how the company is directed or how the company is run. In other words, when you talk about corporate governance, we are just looking at how the company is directed or run. In other words, how are the operations within the business? So this will be referring to corporate governance. But the ethics, I said, ethics is good, If the company is operating ethically, it's good. But what we condemn is the unethical issues that we shall look at. Now, let's look at the key concerns of corporate governance. But one key thing I need you to note is that here we are not studying the entire corporate governance, because you do corporate governance under your auditing and risks, audit and assurance paper. But here we are just picking out key things, because as the manager of the business, as a finance manager, you need to know at least how the organization is going to be managed. Now, let's first understand the key. Let's look at the key concerns that we need to talk about as far as corporate governance is concerned. Key concerns of corporate governance. Key concerns of corporate governance. Now, as I said, here we are not going to be teaching the whole of corporate governance, but we are trying, or we are creating a highlight to pick out the key concerns. And those key concerns, if you don't take into consideration, if you don't look at them, then you will have problems with your organization. And one of the problems, the company may close down because it has not been managed well or directed well. So we have seen over the years, we have seen very many companies failing. And these companies, they are failing as a result of failure in corporate governance. So as long as the company is not managed well, this organization has very high chances of it failing. Very high chances. So over the years, we have seen very many companies. They come and they close, but their downfall, the main reason for their downfall is part of failure in corporate governance. A popular case, some of these are international companies, others, of course, we shall have some few cases from here in Uganda. We have a company called Enron. Enron, it was actually a very powerful company. And this company was being audited by Arthur Anderson. Arthur Anderson. If you try to Google Arthur Anderson, they will get for you the details of who that auditing company was. And by then, it was this Arthur Anderson was the #1 auditing firm in the whole world. But right now, it's no more. It's no longer there because it was liquidated. And the reason as why this Arthur Anderson was liquidated, it was because of the fact that this company had issues. Enron had issues, and these were the auditors. Now, whereas these Arthur Anderson were the auditors, but at the same time, they were the auditors to Enron, but at the same time, they were also providing consultancy services to the same company, Enron. They were the auditors. Of course, when I'm talking about the auditors, I'm not meaning the internal, they were the external auditors. But at the same time, they were providing two services, auditing, and at the same time, they were providing consultancy services. And what happened, since Arthur Anderson was providing consultants, at the same time it was also providing the auditing, the managers and the public were relying on their information. They were relying on their information in terms of the reports they have prepared. So the public was relying to the reports, and even the company was relying to the reports that have been submitted by this Arthur Anderson, the auditing firm. Now, what Arthur Anderson was doing, the auditing firm, what it was doing, it could manipulate. They could manipulate or doctor accounts. They could forge. So what this auditing firm did was to manipulate the records, and they ended up publishing financial information that was wrong. And remember, the public was basing on their information to make their own decision. Even investors, these guys, they published wrong information, and they brought investors to come and invest in Enron because they published wrong information. In a sense that they attracted more investors. In other words, the accounts were overstated. Even the profit was overstated. Even the dividend per share was also overstated. So they looked at the Enron as a company as being a very profitable company for any investor. So investors relied on the information that was prepared by the Arthur Anderson, the auditing firm, to make sure that they invest in this company, Enron. But of course, you know, as long as you lie, people, when they bring in their money and they don't see the return, companies collapse. The problem would have been maybe this Enron wouldn't give. You can't be the same person. You are the auditor, but at the same time you are the one who is providing the consultant services. Consultants may be in terms of looking at what the organization can do. Remember, the whole organization was relying on the information that is manipulated, but they don't know. So that's how the organization collapsed. Even Arthur Anderson also, it was liquidated because it turned out, of course, when you go through the other corporate governance under auditing and assurance paper, you will get the detailed analysis of some of these companies. The other that we can talk about, please take note that these examples we are highlighting and the scenarios that we are bringing, they are the same scenarios that are going to appear in your exam. They may just bring a case and it is just rotating around. They are bringing things that maybe we had the ABCD, it was doubling as the auditing firm, and at the same time it was providing consultancy. It attracted, you know, such kind of story. So those kind of narration is where we will be able to pick the points and be able to analyze what they are talking about. That's why I'm giving more examples. The other that we can talk about is Barings Bank. Barings. This Barings Bank in Britain, this is UK. Now, this one also had the same issue. You can read about, even if you just go and search about this same company, they will give you what happened and what was the result of its downfall. The other, now if we talk about the Ugandan kind of stuff, we had what we call the International Credit Bank. They used to call it ICB, International Credit Bank. It was owned by, I think, Kato, Mr. Kato. It's called Kato, something like that. but this company also collapsed. We also had the Greenland. These banks were there. Greenland Bank in Uganda. Then we also had the known one, the one that was for the government, the cooperative bank. The cooperative bank. This cooperative bank is now the one that we call Stanbic, because it is Stanbic which bought off. It is the present day called Stanbic. Stanbic which bought off the assets of the cooperative bank, but it was a government entity. So Stanbic bought it off. So all these, they declined because of corporate governance and ethics. As if you go through one by one, you look at what happened, what were the things that these guys were doing, you will see that it actually collapsed because of corporate governance and ethics. Of course, currently we have things to do with the Crane Bank, also Crane Bank. The Crane Bank that was sold to the FCU. Crane Bank. So, Crane Bank, and also even Uganda Telecom. You see, Uganda Telecom has issues, even though they haven't sold it. Uganda Telecom. Just imagine if because all government employees, before the government could employ you, you are supposed to first have a UTL line. UTL, Uganda Telecom. Just imagine if at all they had very many products. Remember, it was compulsory for all government workers to actually have these numbers. Just know how many civil servants are there. Those who were there, those who are now being recruited. If it had so many products, and it also goes to the private sector, would be having more, UTL would be like the likes of M10, because it was the first one. It was there for long. And it had some monopoly over, because every employee of the government was supposed at least to have a line before they give you the job. So we also have things to do. There is this Nakumat, I think. Nakumat. Not sure about what happened to ShopRite, but it could be. So all these, most of these companies, they nearly collapsed. Like the Uganda Telecom, of course, it collapsed because of. If you look at what happened to Crane Bank, there were very many staffs. The stories of the fact that we shall look at some of these. The chairman, board of director, was a non-executive, was not related to the business, but the assistant chairman, board of director, was the owner of the business. So what do you expect? Do you expect the chairman to override the decision of the owner, even though the chairman was a non-executive executive director, which is what is recommended. But the assistant chairperson or chairman of the board of directors was actually the owner. So what do you expect? It's like the owner coming in just to see who should I fire and who should I attain based on the decisions they have made, because there is no way you are going to overrule what the owner is saying, even though you are the chairperson board of director. So they just put you there just to fulfill the requirement that actually the chairperson in a good way is supposed to be a non-executive director. So you have a non-executive director as the chairman, but the assistant is executive director. What do you expect? especially now, given the fact that he's the real owner. It's like they just puts you there, just hold the position, but the powers are not with you. So those are some of the things that, because now if this happens, then you just know this person is not good. The chairperson is not going to exercise his or her independence. Remember, the reason as why they are bringing in non-executive directors to be the chairpersons is because they want them to bring in that kind of independence. Because when they are voting, you need to be having someone who doesn't care, but he's just doing the right thing. But here, it's like there is already an influence if the assistant is the real owner. So, under corporate governance, when you look at the principles under corporate governance principles, for instance, as I said, for the principles for corporate governance, one of the principles is the fact that the chairperson board of directors, for you to understand this, you must be well equipped with the agency relationship. Where we said for agency relationship, we know that we have the shareholders. These are the owners of the business. But now, since the owners can't run the business, even though they have money, they can't run the business on their own. So what they do, they appoint the board of directors. When they appoint the board of directors, these board of directors, they are also not employees, meaning they are not going to engage themselves in the day-to-day running of the business. So what is going to happen is the fact that these board of directors, they will choose what we call the CEO, the Chief Executive Officer, or the Managing Director, the MD. These ones are going to these ones employ, or they can also appoint. But remember when we said we looked at agency relationship and in our financial management on level 2, we said there is that first relationship of the shareholder and the board of directors. Here you appoint. The right word is they appoint. So once they appoint you, it means the board of directors are going to be the agent and the shareholders are going to be the principal. Remember, I told you when you're explaining the agency relationship, you make sure you show the agent and the principal. That's the principle for you to actually get the correct mark for explaining this. Then also, when it comes to this, the board of directors and the CEO, these ones, they can also employ or appoint. But this one is going to be the agent, and this one is going to be the principal. So this is what is going to happen. I don't want to explain more about what is done, but I just want you to understand the fact that under the board of directors, we have two types of board of directors. We have what we call the executive directors. Executive directors, those are like the people who have real connection to the business. If the business is failing, they are panicking. In other words, they have a higher interest in the business. They have some interest. It could be maybe these are relatives of the owner. These are maybe brothers and sisters of the owner. It could be other family members and other people, or the spouse. Those are the ones that where the owners pick what we call the executive directors. But the non-executive directors, those are the people who have no interest. They are not connected to the business at all. So what happens is that the reason why we are supposed to have the principle for corporate governance is that you should be having more non-executive directors on the board of directors than the executive. Reason being, these non-executive directors are going to bring in what we call the independence. Because here in the board of directors, communication is always done under the board meetings. And when they are in board meetings, they are supposed to vote. You vote against or you vote in favor. So if you don't have more non-executive directors, the implication would be these people will just influence the decision that is going to be made, even if it is not right. So one of the principles for corporate governance, it says that you should have more non-executive directors than the executive directors. 2, they are also saying that the chairman board of directors must be a non-executive director so that he brings in that independence. Now, look what happened to some of these companies that collapsed. I've explained to you what happened to Crane Bank. The chairperson, board of directors, was a non-executive director, which was okay. But below, the assistant was actually the real owner. So it was contradicting because there is no way the chairperson would vote against his assistant, who is actually the person who employed him or her. So even if these shareholders are going to be choosing, you need to, if they don't follow the corporate governance, then it means the company is going to fail because no one is going to be voting against the bosses or the executive directors. I will explain something like for what happened to the Ugandan banks, like for the International Credit Bank. International Credit Bank was owned by, I think was called Kato. Now, was the owner. This was the owner of that ICB bank. Now, what happened in this bank? The owner, which is Mr. Kato, was actually the chairperson, the chairman, board of directors. And to make matters worse, his children were executive directors, meaning no one could vote against. So his children were executive directors. So there is no kind of independence here. You don't expect a son to vote against the father, and you don't expect the father to vote against their son. So what is going to happen? They will just accept even if it doesn't actually help. That's why when they are choosing some of these, especially the non-executive directors, they choose people who have experience in managing companies that are relatively of the same size like what they are appointing them for, so that they bring in the exposure and the kind of independence. And that's why we want to have more non-executive directors than the executive directors. And that's the reason, to make sure that someone can stand firmly and say that is not going to help the organization. I explained what happened to Crane Bank. The chairperson was a non-executive director, which was a tick. But the assistant was actually the owner. It doesn't make sense. So we have these kind of, I'm just bringing in just the key concepts that I need us to deal with. And these are some of the things that they are going to quote in the case, and then they tell you to advise. So now we want to look at the international. Remember here we are basically looking at the entire, this is an area of international concern, corporate governance. So we want to look at what happened in different, or how can we be able to manage the organization well. Of course, in the UK, in London, they had a committee. A committee was formed to come up with standards on how a corporation or on how a company can be run. And the person who was like spearheading was called Chadley. He came up with a report on corporate governance and made very many recommendations. Even in South Africa, this was in London. Then also we had some recommendation from South Africa. Now, for South African case, it's most of the times what we are basically using. And I will tell you why. In South Africa, at the highest peak of apartheid, that apartheid period, there was a judge, a high court, actually was a high court judge, was called King. And what happened was, when the whites lost on apartheid, they said that they tried to focus on companies. They decided to transform companies, and they become a more organized place. That's why we are seeing most of the times, most of the companies, they are coming from South Africa. It was as a result of apartheid, where they sat and they concentrated, they tried to transform companies. So by transforming companies, this judge, they wrote reports and they made numerous recommendations on how companies can be managed, because most of the companies were destroyed. So they wanted to try to find a way how they can come back together. So they had to get those recommendations. So we have that high court judge called the King made some recommendations, and the first recommendations, they are the ones that were in the report, which they called the King 1. It was also then modified to King 2. And finally, this King 2 was also transformed to King 3. And it is this King 3 that is still relevant, or that is recently used. But also, when we talk about the Ugandan aspect, we also have things to do with corporate governance. In Uganda, we have the Institute of Corporate Governance, and they have also made some recommendations. And we also have the Commonwealth. Also, the Commonwealth made some recommendations, but the recommendations of Commonwealth were more like the ones that were recommended by Chadley. So the Commonwealth reports and the Chadbari reports, we are taking almost the same side. So they tend to follow, the Chadbari report tend to follow the Commonwealth report or recommendations. But as you go into your auditing, you'll learn more about that King report. Even if you try to Google, it is a very big document, but you pick out, you look out, you go into the table of contents and you pick out the recommendations that we have. But as I told you, before we go to ethics, I told you that there are key elements that you should note from the other side. We said that the non-executive director is supposed to be the chair, is supposed to be made the chairman, the chairperson or the chairman, board of director. 2, we should be having very many non-executive directors as opposed to executive directors, so that they can be able to bring in that kind of balance when they are doing their voting. We also spoke about the key people that pray or that made their recommendations. We spoke about the king, who was the High Court judge in South Africa. After the apartheid, they looked at ways how they can be able to transform companies, and they made some, that judge made some recommendations from Judge 1, from King 1, that was the first report, to King 2, that was the second report. They kept on modifying those reports until they went up to King 3, which means report 3. We also talked about the fact that in Uganda we have the Institute of Corporate Governance that also provides some recommendations on how a company can be managed. We also spoke about the Commonwealth reports. We also talked about that we had the Chadbari report, but we concluded that the Chadbari report is taking the form of the Commonwealth report. So those are some of the highlights that we looked at in the previous video that are very basic and you need at least to understand. So now let's look at ethics. Now here the examiner may throw like 4 or 5 mark question, especially under the question 1, because I told you ethics and corporate governance plus Islamic finance, they are more seen in the question 1, section A. And these questions keep on coming. Most of the times the examiner doesn't examine a full question on corporate governance because it is more of theoretical. It is more theoretical than computational. So it's not going to be a full question. So you can't have a full question on ethics. But as a finance manager or as the CFO of the organization, you must be ethical when you're executing your duties. So the way we study it, or the way we analyze it, will come from the unethical behavior, unethical point of view, because these are the things that we don't want the CFO to promote. The CFO, the finance manager, shouldn't promote these. So those are the things that they shouldn't promote. So we want to look at what are the ethical, unethical issues. These issues, we are not going to explain or to over-explain more on them, but just know they may appear. I made a video on financial management that is detailing some of these things. Like 1, we have what we call money laundering. Money laundering. So here you are just expected to know what? You are just expected to know briefly about money laundering. Whether you should promote it or you shouldn't promote. But this is just illegal money. Money came from unknown sources. So they may bring scenarios that maybe like what happened to FDC. They were complaining that money came in and they were not aware. Where they didn't know the source of the money. So that's money laundering. But most of the times it is done internationally, that people get money from unknown sources and they bring it in the country. So it is very dangerous. So we have other things like corruption. This one, self-explanatory, but most of the times when you are giving points, at least make sure every time that you make corruption the last point. Because some of these other aspects, they are more related to corruption. Like I can talk about insider dealing. Insider dealing is when you use the information that is private to you for your personal benefit. For example, I may be the CFO, but I see that the company maybe is trying to sell shares. And I know in 5 years' time, the company will be making very big profit because I'm the one who is looking at the financial statements. I know. And because I have access to that information, then I tell maybe my sister or my brother to actually come and buy shares. So I'm using the information that to enrich myself, because the information is just only private to me. Otherwise, no one would know that in 5 years' time the company would be more profitable. The other that we can talk about conflict of interest. This one is more evident. Most of the times, if you see that you can't handle a case, it's like auditors are not allowed to audit companies that they have shares in. It's like you have almost 10% of the company's shares, 10% of the assets of the business, and you want to become the auditor. You can't, because you have already an interest in the business, meaning you will do whatever it takes for the business to be profitable. It's just like the same way I can be having a business, and then maybe my wife is an auditor, and I tell my wife to come and audit my business. What do you expect? Remember, you are supposed to be seen. You must be independent, but you must also be seen to be independent. There is no way someone is going to say, even if actually you exercise your whole independence, and no one will believe, because they will say, after all, the other one is the husband. The other, we may talk about like bribery. Of course, if you see bribery, corruption, they look to be the same. Bribery. But I told you that we can also talk about fraud. We can talk about doctoring accounts, manipulation of accounts. There are very many issues, but the key point is the fact that most of the times they bring these items in the case. It's you to identify that this was unethical, this was this, because they may just give you a story. Then in that story is when you will be able to advise. Remember, we told you, even if it's not all about knowing these points. You may be knowing these points, but they are not applicable to the case. So if they have not mentioned the corruption, please don't bring it. You bring in pollution. Of course, we know pollution is, you are not allowed to pollute the environment. But don't bring it if it is not there in the case. So you can try to look at the exam past papers. As I said, you follow for the new examiner 2019 to date. Then you look at how the examiner has been examining these numbers, because they are there in that question one. Most of the times they are there. So you look at how the examiner has been examining the things to do with ethics. But we always, and the other thing is the fact that most of the times they may just give you signs. They may not just give you these direct points, but they may give you symptoms that they may give you a case. Maybe I'm an accountant and I'm delaying payment of the supplier, yet there is no justifiable reason for me to delay the payment. Of course, when I look at that, it can call for bribery, that maybe I'm looking for someone to give me something so that I can approve the payment. It can also lead to corruption. So they may give you any case. Depending on the case, you analyze the case and based on that to make decision. So thank you for watching. Let's meet in the next video as we are going to be looking at securities and financial markets as our new topic. We try to look at, I know we looked at securities and financial markets and our financial management, but here we are just taking something. We take something to be a little bit advanced. We pick out something few, small, and we talk about it. But that doesn't mean that they can't examine that number in full. That's why it is more advisable that if you have the notes for level 2, keep them. Read it through as you keep on advancing, because it is the other one that is going to prepare you for this advanced paper. So let's meet as we talk about securities and financial markets in the next video. Hello viewers, welcome back to our YouTube channel, KC Accountancy Education Center. And today we want to look at a new topic, and we are going to focus on what we call the securities and financial markets. So we are going to look at securities and financial markets as our new topic. Securities and financial markets. Securities and financial markets as our new topic. So today we are going to look at securities, and when I say securities, I'm referring to what we call the financial instruments. Financial instruments. So when I talk about securities, I'm basically referring to financial instruments. And the financial instruments, they are the ones that are traded in the financial markets. So the topic is financial instruments and financial markets. We want to look at the instruments or the items, the financial items, and where they are sold. So financial instruments and financial markets. So the way you were taught financial markets at your level 2 is the same way we are looking at them even here at level 3. And there is nothing that I'm going to add on that is new to what you know. So because it is going to be the same thing and we are going to be basically using the same knowledge, so we are going to pick out the things that I see they are very important as far as this paper is concerned. But basically, you can also use the same knowledge that you got on level 2. It will be the one that will help you to understand most of these things. So we shall look at, after looking at that, we shall also look at the finance decision. We shall look at the finance decision. And now securities actually link to, these securities, they link to the finance decision, because that's where we are getting the money from. So the securities that we are talking about here, they are the ones that will lead us to the financing decision or the finance decision. So these securities, they are the ones that are going to help us to finance our activities. In other words, It's the source of money that we are going to use to finance our investments. Now, the financing instruments that we are going to mainly focus on, they are the ones that are of long term. They are long term in nature, long term financial instruments. So we are basically going to focus on the long term finance instruments because they are the ones that are going to help us to finance our long term investment ideas. So these are the sources of finance, or the sources of funds that we are going to use in our investment projects. Now, when we do what we call the investment decision, or what we call the capital expenditure, the capital expenditure, they put it in a form as capex. It is put as capex in our, abbreviated as capex to mean a capital expenditure. So this is what we do under capital budgeting decision, or what we call the investment decision. So when we are looking at capital budgeting decision as the investment decision, then you need to look at the different sources, or you have to look for the money to be able to finance these decisions. Because you have made a decision, maybe you are going to invest in real estate, but you have to look for finance that is going to help you in that kind of investment that you have selected. So ideally, this topic should have come actually after when you have completed capital budgeting decision, because it's until when we are done with that capital budgeting decision that we can know which investment ideas that we are going to basically look at, that we are going to look for their finances to fund those different projects. So, but either way, we need to get this straight, that the sources of finance that we are looking for, first of all, they are long-term in nature. Two, these sources of finance, they are the ones that we are basically going to look at where they are traded. Either they are stock market, or they are capital markets, or money markets, as we shall be able to see. So after looking at the finance decision, we shall finalize with what called the financial markets, because we need to first look at the sources of finance themselves, then we see where can we find these sources of finance, and those are the financial markets. So we want to see what are some of the areas where the examiners examined some of these numbers. So I want to give you reference numbers for the questions that are rotating around securities and financial markets, or what we call the financial instruments and then the financial markets. So let's look at the reference questions, or what we call the trial numbers. Let me just use trial numbers that are basically on this. So we have question 4, part A, May 2019. We have question 3, part B, November 2019. We have question 3, part C, November 2019. We have question 5, part C, August 2019. We also have question 5, June 2022. We also have question 2, part B, August 2018. We also have question 2, part B, November 2019. 2019, no, this is 2017. Can also look at 2017. Then the one for 2019, the other question is question 5, part D. Then this is June 2019. You can also look at question 3, December 2021. There are very many questions. Then finally, if you want to look at more, then you can also look at maybe question 5. Question 5, November 2011. There are very many questions that you can look at. Some of the questions that I'm not providing here, some of them we are going to do them in our revision. So don't say that we are not seeing 2023, 2022. Some of the questions we are going to have the revision sessions at where we are going to be analyzing some of those different aspects. But I want you to start from, because I told you at least you should get past papers that are 2018 to date. This was November, I think, November or August, because the new examiner started in November 2019. November 2019 for this paper. So let's now look at the finance decision. So I want you to see that some of these things that we are going to be talking about, they are really examinable questions, and I want you to pay attention to them. I bring some of these in the very beginning because I want you to get them first before we go to the computations that will take some of our time. So the earlier I do it, the better. So we are going to look at the finance decision. We talk about a little bit, we are not going to go into deeper into what we covered on level 2, but we are going to pick out some of the key things that we think may be important for this very paper, basing on these different questions that have been set. So let's meet in the next video as we are talking about the finance decision.